The race for Great Offshore took a dramatic turn today with ABG Shipyard offloading almost its entire stake in the company. Now, this stake has been picked up by Edelweiss Capital at 577 rupees per share. However, ABG says it will still go ahead with the open offer to shareholders of Great Offshore at 520 rupees per share, Vivek.
That's right, Shireen. Late last night, the other bidder, Bharati Shipyard, had revised its offer to 590 rupees per share. So tomorrow, shareholders of Great Offshore will have to take a call on both the open offers.
Well, the question on what's hot is, why did ABG Shipyard stay in the race if it did not have a strategic intent in acquiring Great Offshore? Joining us now is Professor J.R. Verma from IIM Ahmedabad, and our managing editor, Udyan Mukherjee, joins us as well. Udyan, let me start by asking you, if you study the curious turn of events in the race for Great Offshore, where does this really leave ABG and Bharati Shipyard?
My own sense is that Bharati Shipyard has got very, very stretched in their bid to retain control of Great Offshore. Because I think if they have to do two open offers, as seems mandatory, then they may end up paying close to 1,500 crores for acquiring their stake in Great Offshore. Now, that for a company which has a market cap of 400 to 500 crores, which has debt of nearly 1,400 crores on its books, and which is taking on an asset, Great Offshore, which has 2,000 crores plus of debt on its books, I think makes for a fairly expensive and stretched acquisition. So I think Bharati, despite some business rationale because of protecting its own interests and orders by the acquisition of Great Offshore, might have actually stretched itself. And while the stock went up today, I think shareholders need to scrutinize whether Bharati has overpaid beyond the region of fair value and well beyond it at that open offer price of 590. For ABG Shipyard, it has made a trading profit because its cost of acquisition is much lower, and it sold the shares at 570 today, and therefore it makes some trading profit. So it can potentially walk out of this deal having made some profit, though some of it needs to be plowed back in the open offer, and it will probably get some tendering even at the lower price of 520 in the open offer. However, what might get questioned is ABG Shipyard's motive, because I think there might be allegations that ABG Shipyard always had the motive of selling the stock at a profit and never had an intention of acquiring a strategic stake in the company, and therefore it played an active part in pulling the stock price higher to 500 plus and then sold at a profit. So I don't know whether that goes against or is a violation of the letter of the law, but might be seen as a violation of the spirit of the law. So I think there's a little bit of grey area out there, but ABG comes out with a profit from this deal.
Right, Udyan, where does this leave the shareholders of Great Offshore, who now have to take a call on not one, but two open offers?
I think the arithmetic suggests that shareholders of Great Offshore are best served by tendering in a mix, because the acceptance ratio for the 590 offer is only 26%, and the acceptance ratio for the 520 offer is between 40 and 50%. I think if you tendered in a mix of, say, 70-30 or 80-20 in favor of Bharati Shipyard's offer, the realization to the shareholder of Great Offshore might be the best. So I think you'll have a curious situation tomorrow where, I would venture to say almost without precedent, where people will tender to maximize their arithmetic gains or gains arithmetically by responding to both the open offers at the same time. I don't remember a precedent of that in our takeover history. So it is surely interesting.
Well, to analyze the greys, we've got with us Professor J.R. Verma. Mr. Verma, many thanks for joining us. Let me begin by asking you, the grey areas Udyan was pointing out, they may not be in violation of letter of the law, but in spirit. How do you actually explain what Bharati has done?
Well, you see, I think at one level we must recognize that this is exactly how the takeover system is supposed to work. That you had a company where the takeover is initiated at 350 or something. You have competing bidders bid the price up. You get it up to a full value of 590, and at that point there is one bidder effectively left in the fray. So that's exactly what should happen in any bidding war. The price starts at the point where there is a lot of money on the table. Competing bidders take that whole thing away, and the shareholder gets full value or pretty close to full value. And at that point, somebody who is not able to pay that price walks away. This is what should happen in any bidding war. In India, things are a little messier because we have all this partial takeover where you make open offers for only a part of the company and so on. Ideally, if the open offer were for 100%, then what you should really have is that the lower priced bid should simply not proceed. That, when both are cash bids, just the higher priced bid is all that needs to go through. The other open offer should simply be allowed to be withdrawn. We are not able to do that in India because we have all this partial offer business. I hope that with the takeover code being under review, we will get rid of this partial offer, and then this is exactly what should happen. You will have a bidding war. At the end of the day, one person loses, one person wins, and the winner's open offer proceeds. That is what should ideally happen in a sensible, rational world.
Right, Professor Verma, while that is a suggestion which you've put up to this committee to look into for the future, but let's get down to the specific as of now. While ABG Shipyard says I'm not withdrawing the offer because as per the SEBI regulations they can't, because they don't fulfill most of the requirements. If you remember in 2002, the one clause that because of a competitive bidder you can exit was removed. So that's not an exemption available. However, my question to you is that when you did make a public announcement, as in ABG Shipyard made it, it said very clearly that I am intending to take strategic control. What it's effectively done today by exiting 8% of the shares it had mopped up over these few months is to say that I'm actually going away from that intent completely without having made any announcement to that effect prior to having sold the shares. Do you see some grey area there?
I don't really think so. You see, whenever you have a competing, a bidding war, both people have intention to acquire the company. At the end of the day, you find that, one person is not able to get it. You know that the other bidder is going to walk away with the bulk of the shares. You will not get control or anything approaching control. And then, you throw in the towel and walk away.
But the law doesn't allow you to do that. Professor Verma, the law doesn't allow you to do that because the law says there are only 3 conditions under which you can withdraw the offer. I mean, I know technically they're not withdrawing the offer, but the fact of the matter is there's a clear change without having, the law certainly says that if there's a change in your intent or in the public announcement you made, there is a certain procedure to be followed for that, right?
No, what I'm saying is that ideally the lower priced offer should simply be allowed to be withdrawn. That is what happens in many other countries in the world. In the UK, for example, as a matter of course, the lower priced offer simply does not proceed. Only the higher priced offer proceeds. They're able to do that because they don't have all this, acceptance ratios and 20% and 25% and all of that. But ideally, that is what should happen. Why should somebody be buying at 520 when somebody else is there to buy at 590? Why should the investor be left with all this utterly confusing scenario? Ideally, one should simply have a price discovery has happened. The price discovery is that a controlling interest in Great Offshore is worth 590, and that's the only offer that should proceed. And ideally, that offer should have been for 100%. That is what ideally should happen. That is what would serve the interests of the investors. Now, when you put in all this complicated stuff that you can't withdraw, even though you have lost the bidding war, you can't withdraw your offer, I think we've just created a very artificial kind of a regulatory structure. And we have to ask, are takeover regulations meant to protect investors, or are they meant to allow lawyers to make money and merchant bankers to make money and, do all of that? I think we must be very clear that this is there to protect the interests of investors. The interests of investors are protected when they're able to sell into the highest bid. That is what should happen, and that is what happens around the world. This may be first time kind of a thing in India, but this kind of bidding wars happen all over the world. All over the world, the bidding war goes on till the very last minute. At the very last minute, one guy says, look, I'm not willing to increase the bid any further, and it is all understood that then the other guy walks away. That is how it operates all over the world. Why India should have such a convoluted legal system which creates all those permutations? That is what we should be examining.
Right, Professor Verma, coming back to what has happened today. Now, you have a situation where you are an acquirer, and you would agree that an acquirer of shares for the last 3 or 4 months after a public announcement has been made is, of course, privy to a lot of information which is material, in the sense that even if one share is bought by this acquirer, the entire open offer price changes. Now, as Udayan mentioned, at the end of the day, it's been a trading operation. You've sold those that 8% of your holding, booked profits. Do you think that is right, not under the takeover regulation, but otherwise?
that issue arises only if you had some confidential information. I can understand if there was a due diligence process in which confidential information was revealed, and then how do you act on that confidential information? But in a typical a hostile bidding war kind of a thing, I don't think that issue really arises. I don't think that arises unless there is privy to some confidential.
All right, Professor Verma, we will have to leave it there. Many thanks for joining us. It is going to be a good time as far as the merchant bankers and lawyers are concerned, as Professor Verma was pointing out, but no precedent so far, so this could perhaps be a starting point for discussion and debate as far as the takeover regulation.